I'm pleased to welcome everyone at our meetup. I'm Alex, my name is Alex, and I'm head of business intelligence department at Instinctools company. And here with us is Maxim, our finance and modern business consultant. He has great experience in M&A deals, and we'll talk about it today. So, if you are ready, I have some questions for you. Maxim, how do you think how the M&A process evolved during the past years, and how can technology-driven data challenge the deal making?
Well, yes, the M&A, the way we are approaching the M&A deals is changing, and we have to consider the simple fact, the mere fact that companies are dealing with lots and lots of data, underlying data, not only finance data, but all kinds of operational data, of kinds of monitoring data that is being produced not only by business units or by the simple fact that the potential customer has entered your offline shop, the real shop, the brick and mortar shop, or just clicked on the article on your website. There is tons of data, petabytes of data that is being also produced by the universe that we call Internet of Things, and this is just becoming really impressive with every year coming. But when I'm talk with the executives, from what I see is like 4 out of 5, they believe that data analytics and more specifically BI will become even more increasingly important to the mergers and acquisitions deals in the coming years. Look, people I'm dealing with are businessmen, or they have a strong business acumen. When you're considering to buy a company, you have to decide, well, is it a good fit for my purposes, for my investment portfolio? Is it profitable? And what would be the fair price? Okay, you tend to pay as little as possible, but you also have to think about the interest of another side of at the negotiations table, right? You cannot rob people; it's illegal. Huh? And to start, when you're doing your analysis, kind of reconnaissance phase, you're gathering the data from tens or even hundreds of potential target companies. And you look at all those classic KPIs, return on assets, return on equity, on capital employed, profitability of sales, EBITDA figures. And then, okay, this is just the first approximation to arrive with kind of a short list. Let's say, okay, from 100, I came down to 5 or to 10 companies that I would like to approach. And then you get to know each other with all your as a side that is interesting in buying over, because in the most of the cases I'm talking about my experience, I act on the side that has bought another company, target company. And you're in the valuation techniques, the one that is prevailing now is the company valuation method that is based on the discounted cash flow of your projected operations. And as you guess, 2 parameters that you need to think about, okay, are the projections trustworthy? Are they based on information that is correctly, that is correlating with what a kind of development path the target company is following, and whether those assumptions are realistic. And what I see, I'm working on an M&A project, and I have seen the part that was done in a due diligence phase by some financial experts. I have seen like tens of Excel files, and some of them contain like 50 plus of tabs, all filled in the data. Well, those consultants, I'm not going to say their name, they have done a fantastic job in their opinion. Because what you see is the monotonous Excel tables. Well, somewhere you have a graph. But it's really difficult to form an educated decision based on merely that. You need, on the contrary, a business intelligence tool that is properly configured will provide you with ready to read graphical visualization with the option to go from the dashboard level, from the graphics to the underlying data.
To drill down. Yeah.
Yes, okay. And what you're getting, what you are not really getting with simple Excel, you are getting the insight in the true story of the company you're considering to acquire. And the technology is also evolving. You are not only dealing with acquiring the physical assets, inheriting the social capital, the personal, the people. You are not simply taking over, okay, this is the client portfolio, these are our business processes, but all this stuff that you just mentioned, they have a common backbone, IT backbone, yes? And when you think to combine two entities or more, if you're taking over, if you are a group of companies and taking over a smaller group, well, you have to think in terms like, okay, what my future enhanced IT infrastructure is going to be, and what I have to do, how I have to act in actually realize the potential synergies I envisaged in the first stage. And I hope I have convinced you that the influence of the technology and of the data analytics tools is going to further increase in the future. It's going to become massive, heavy. The guys who combine the business acumen with the technical skills of developing and configuring those BI tools, they will be very asked for. They will be very instrumental to the as critical support function in the M&A deals. And yes, if you want to catch up, hop on the BI train, as I name it. Otherwise, your competitors will leave you behind. This is it, huh? This is
thanks
fact.
a lot. So it seems to me that it's very important for the M&A process to M&A for the IT infrastructure also. And how do you think when it's better to start, if we are talking about the M&A process, when it's better to start the implementation of BI tools to get the maximum impact of and the maximum value of it?
Well, in the M&A, you have the pre-deal stage, and then you have actually what is being kind of a deal stage with the due diligence phase and negotiation phase, and then you have a post-deal stage. BI is applicable, is useful for all those stages, and the sooner you are able to engage those technologies, the less risks you have in the M&A deal. What is the most important risk they are facing, the most threatening one? Well, it's actually a bubble deal, when you just pay too much for a business, or you are paid too much, or you got seduced by the revenue projections that a business you were looking at has provided you with, and you bought it, huh? You bought it, but then, and I have seen in the practice, I have seen that the revenue growth projections were not like deviating to the worse by tens of the percents. No, they were deviating like the sales revenue was 10 times lower than the one that was projected. And yes, then it's too late to renegotiate the deal. So coming back to the M&A deals, one of the most important aspects you are dealing is risks mitigation, right? And you don't want to pay too much. You don't certainly want to be deceived by a fraud when someone was deliberately kind of cooking the books or drawing up the growth projections that turned to be unrealistic. So, but when you talk pre-deal, you only have the access to the public data of the target company. So the number of the things you are analyzing is quite limited. You actually you see some financial statements. Okay, you can read the quarterly reports if we were talking about public companies, but still, even then, if you use the data from the analytical reports, you can build revenue growth trends. You can analyze the profit margins, and you can kind of make a comparison of the target company versus the sector they're operating in. You can compare them versus the peers, and that's quite a cumbersome exercise. I was doing assignments like that, and you want to have a tool that is that eases your life in gathering the data, streamlining the data, and translating them into some graphical some graphic level, because analysis, it's not only about number crunching, Alex. It's about the message that you convey, and as we all know, a picture or moving picture, talking picture is better than like hundreds of words. So well, the usage of your BI tool starts in the pre-deal stage, and further on, the potential impact and the potential benefit of BI tool application only increases. Talking about the the deal stage, and certainly post deal. And you don't, when you use BI tools, you want to have an action plan, and you want to make your business decisions well based and interconnected. And and in the digital era, those decisions, you cannot be like super intuitive and saying, okay, we're gonna do this without relying yourself on some properly analyzed, grouped, and sliced and segmented data. This is exactly what a BI tool can do. And when, again, coming to the risk assessment, well, the risk assessment is based not only on a judgmental opinion, it's based on there is a methodology of assessing the risks in all for all processes and spheres where the company is operating, and it should be based on the precise, infallible data involving all the departments of the company you're considering to buy. And well, of course, you want to identify whether the company's financial reports, they reflected a fair view of what has happened in the past. You want to get know of whether the forecast projections accurate, and just to there is a classical example of how badly you can be mistaken when you missed something and some alarm bell didn't ring. In 1994, and we were talking about the time when both of us were young, and probably well, at that time I didn't know about even the existence of Excel. To start with,
think
not
most of us.
not speaking about the the more advanced data analytic tools, but in 1994, the company called Quaker Oats acquired a drinks company called Snapple. They paid in 1994 $1.7 billion for it.
Okay.
They truly believed that they would be able to further, because actually Quaker was successful with launching its drink with the trade name Gatorade,
Okay.
and they wanted to further to actually to exploit the trademark of Snapple and to further develop the assortment, but they failed. But they failed due to the various reasons. But the harshest reason that struck me is actually they missed the fact that the the revenues of Snapple, they dropped drastically in the last quarter prior to the acquisition. And the result is that window, there is always that gap between the pre-deal and due diligence stage, and then you kind of doing the negotiations, and kind of, okay, these, if we are talking about public companies, you are fulfilling your compliance duties, you are getting the approvals from the state authorities, because you have to be like, okay, you have to comply to the anti-monopoly legislation. But they missed it, and they missed it bait. They just throw away $1.4 billion in 3 years' time. I don't believe they were planning to lose money. They wanted to make money, but they failed on the methodology of the business analysis, and probably also on the tools. And this is why they failed.
It's just a nice case. No, thank you, Maxim. And we already started to talk about the pre-deal stage, the first stage, and it consists of the due diligence and the negotiation. Could you please describe how business intelligence can provide comprehensive and valuable analytics for the acquisitions or for the mergers?
Well, yes, you're right. So we are talking about due diligence and negotiations phases. And when you're considering such important aspect as data access in the M&A deals, at the first, there is kind of Chinese wall between the companies. You just don't have access to the to other set of data than publicly available data. Subsequently, when you move on, you go to the due diligence, and then you sign all those nice non-disclosure agreements, and then you can dive in the company's sales register, in the company's or sales orders books. You can look up what is happening in the CRM system, and then the real work starts. Then actually you can use the data. You can access the data that on which the statements of the company, that is, of the owners of the target company, are based. Like, okay, we are having a wonderful business, and we are not going to sell it for less than X dollars, because why? Because they have the plans. This is our sales forecast for the coming 3 years, and the market we are operating, especially if you are talking the digital business, like the overall pie is getting just bigger and bigger, and you're just lucky that
wait for a while and we will buy you.
Yeah, wait for a while, or we will. Yeah, yes. If you don't buy us today, the next year we will gonna come and buy you. Yeah. But well, you still want to protect yourself from a bubble deal. Yeah, I mentioned it earlier, and you have to be scrutinous when it concerns such aspect, like earnings quality. So you just you want to get assured, to get some kind of insurance where, for example, if the profits, the future profits, are based on the portion that is called recurring revenue, and when they're kind of selling subscriptions or whatever. Well, you might want to question, just for the benefit of mutual understanding, whether that portion of why you believe that your portion of your recurring customers will increase from like 30% to 60 in just 2 years' time. Well, because these can massively influence the acquisition price. Then you have, like, when we are talking about more traditional industries like classical production, yes, or like manufacturing, you have the a post in the balance sheet that is kind of being considered a liquid asset, receivables, but there is such aspect as bad aging and doubtful receivables or non-recoverable receivables. You have to conduct aging receivables analysis. There are also some cases when certain people involved in finance, they might want to, for example, to make the actual figures of revenues and profits matching better to the forecasted ones, because stock exchange analysts, they love that. And yes, if you are only looking at the public available data, you won't catch this. It's gonna stay invisible because it's 2 or 3 layers lower in the data, deep in the data. But when you're gonna analyze your sales transactions, sales related transactions by types, you might be able to catch up those sales reversals that were done. Let's say you have made some non-invoice related sales revenue entries in the last month of the financial quarter or the financial year, and in the next period you just reverse them. Well,
but you have some questions about it.
You have I would say you would certainly have some more hot topics to discuss with your the business partners. And a properly configured business intelligence solution is capable of drawing quite an accurate and like the big scope picture of company operations, starting from the point of data gathering, of capturing the information, to the outputs. And you can start, and this kind of opinion that I sometimes hear from the people I'm talking with, socializing. Well, but the real work is only starting at the post deal stage. Well, surprisingly enough, you have to be aware, and you have to be able to unveil the power of BI tools earlier, much earlier.
Okay, thank you. So currently we're talking about the pre-deal stage and how the situation changed when we move on and come to the deal stage.
Still, and I should confess to you, Alex, BI tool is not an almighty thing, like push on the button thing that will do everything for you and provide you with a device that you should 100% rely on. The interpretation, I mean, what system can provide you are the recommendations or trends visually represented by people with analytical brains. They're still important to the process. However, when you use your BI, your employees, your decision makers would be able to do more in finding what's best in your business, what are the growth opportunities? What are the cost reduction opportunities? Everything that is being united under one fancy word, synergies. When big bosses, they negotiate. Okay, when a CEO of the company that is acquiring target company is preparing an executive resume to the board of directors and to the shareholders, a very important aspect that is being looked at are the synergy effects. How much more money we're gonna make as one company under our management style, as a company that adopts our corporate culture and implements all brilliant business and development ideas that we might have, versus if two companies or two group of companies were operating separately, independently from each other. You might be surprised, but in 70% of the cases, the figure that represent the synergies is massively overvalued. Therefore, what it means that no proper analysis or was done at the deal stage. And when you move at the deal stage, you kind of try to look at the aspect that is called increase of asset effectiveness of the target company. You can bring together the information from the sales order books, from the procurement department, from production planning, from maintenance, from warehouse, from logistics departments, from pricing officer, because lots in the changing world where we have some crazy trends with gas prices, etc., can be reached with a smart pricing policy. But in the ideal world, you kind of try to look at what the optimal combination of product mix would be if we are talking about a manufacturing company, would be for a big new company to produce to maximize the contribution margin and still yet respect the limitations imposed by logistics, warehousing, and production departments. You can also determine, when you bring the managers from two companies together, you can determine which products would receive the highest priority to be launched onto the market, because your investment portfolio that used to be managed independently is going to become one. Well, in this case, you need some tool to bring together not only the underlying data, but also to streamline the analysis and decision-making process. And this is where the BI tools can be operational. Also, they're operational if you want to define the synergy effects, not as just, this is my best guess approach, but by building up from the data. Okay, you can have some major hypotheses, like cornerstone hypothesis, but you have to underline them, to support them with the data that match your hypothesis. Or, okay, in some cases, the hypothesis can be proved to be wrong. There is nothing wrong about that. It's better than to promise something on which you cannot deliver. So there is also such an important aspect that almost no one is thinking, and there is a good reason for that. There is an aspect of, say, okay, my acquisition is not yet finalized. We are onto the deal stage. It's almost, but we are not yet there. But we have defined which kind of operational profit increases or just cost savings, we have to realize at the post-deal stage. And when I have seen it numerous times, when there is such an important person that is often being omitted in this process, and this is a person, chief information officer. Sometimes what they ask from this person is just, okay, what is your view on the digital maturity stage phase of the company we are envisaging as a target? Okay, and is their network safe enough? Well, do they comply? But the question that they do not ask us, well, look, when the deal will be finalized, we have to monitor, to gather information to monitor, to control, and to analyze a number of KPIs for both businesses, for the global business.
To integrate it.
Well, yes, but you have to start now already kind of to do drafts, develop and roll out a BI system combined with data marts of the full data warehouse and all those everything that is under the bonnet. I'm talking about the ETL. But you have to start now, because you say we signed a deal on now we are the 20th of September. Well, yes, but then we will have the third quarter reporting, and what?
And you don't have a couple of years to make the integration and to make the new figures.
You have to be fast. And you cannot, okay, granted, you cannot roll out a fully scope ERP system in 10 days. But, and I know how it works, you can roll out some BI solution that is focusing on certain aspects of data gathering and processing. That's gonna work. That's not gonna cost you a huge amount of money, but that's gonna enable you with to say, well, I know what is happening in the new business,
and you can control it. Yeah.
Yes, sure.
Okay, thank you. So it looks like the first two phases were the most tricky parts of the M&A process. But what goes next? When we come to the post-deal, how changes the life? Is it all okay and we just operate, or there is some issues also?
The life just becomes real.
Yeah.
Alex, it's the same as in classic relations. You see, two people are seeing each other. They get to know each other. They get to know each other about the values, the cultural background, the plans of each other, and then they kind of making a go no go decision. Okay, should we make a step further, like come to live together or to marry? And a deal stage is a wedding party. And then the next day comes, and in the corporate world, there is no honeymoon. No, there is no.
You just
there is
leaving.
Yes, you just shift to the next gear, and in order to make this marriage work, well, not only you have to have a contract, but you have to deliver efforts. Both of you, yes. And then we start to talk about such aspect as corporate culture. Corporate, and then on top of that, okay, even operational, yes, you have those synergies in mind. You want to prove to your shareholders or to the guys you have borrowed the money from that it was money well spent, and we're gonna get back the money, you're gonna earn the more and for yourself a bit. But you have to to roll out the system that will be capable of tracing probably the new KPIs that the target company you have purchased didn't used to have. Like, well, the example that pops up in my mind is when a chain of retail of retail shops was acquired, and the new company wanted to measure the leads or the visitors to your shop versus the time they have spent in the shop versus the average receipt total amount, and compare it with the assortment with and try to make a correlation. Okay, is it at the top location, not top location? And I mean, there are like huge opportunities, but you have to be instrumental. You have to be empowered with the right tools to do this analysis.
And to have the information to analyze.
Yes, certainly. Yes. And you have to invest in it, and you cannot just come and say, it's like in Minecraft, I installed all those fancy sensors and it will work. No, you will have to click with your fingers a few more times. Huh?
Okay, thank you. So we've passed the post-deal stage, and one more aspect to talk about, what happens with the corporate culture of both companies at this stage?
Well,
when they start to live together.
It evolves, and okay, there is still always the law of the strongest one. In most cases, the classical cases, the company that has bought another company is kind of imposing the new elements of the elements of new corporate culture. But this is not the first thing to start with. Even at the negotiation stage and in the pre-deal phase, there is a kind of a decision that is being taken and voiced out, like, okay, are we a corporate culture match? Why is it important? It is important for retaining your social capital, because corporate culture is linked to people, to personnel. When people lose their jobs, not lose, they quit. If someone quits the job, in most of the cases, it's not happening because the person was unhappy about the job itself. It's either because of the manager or the corporate culture that was not a fit to the personal culture, the personal priorities and cultural code of the person involved. Well, when we are talking corporate culture, we are talking HR policies. When we are talking HR policies and personnel, the things that come in mind, the pay system, you have the pay scales, and you have the career development plans, and you also have like the way the company and the individual targets for the year are being translated in the remuneration variable portion, which is bonus. And it would be fair to say that you would, as an owner, as a CEO of the new company, you would like to take the better from the two worlds. Yes, it's not necessarily that the culture of the largest company who bought another one would be adopted. In most cases, it is so, but still they tend to approach these elements step by step. It's never a big boom like babam from Monday we're gonna be different. the culture is being reflected in your behavior, and it takes like at least like they were saying about like 7 weeks. It takes time to change your behavior. So, but even here, you have the BI tools that you can use to analyze the discrepancies in the pay system, in the pay scales, salary scales. You can also have some targets for cost savings when you kind of commit yourself to implement some elements of RPA, robotics process automation, in some routine tasks. And then, yeah, you're gonna fire people? No, in most cases you are not firing people, but you reorientate them to engage them in the tasks that will be adding more value to the company, creating more value to the company, and still be happy.
Talking about the employees, it's kind of sensitive question, and you started to describe it, and I would like to focus your vision on this. Maybe you can describe some more mechanisms. How can HR or how can BI help to analyze the situation with the employees in the post-deal stage when we come in one company working?
Well, yes, the employees are crucial. And a fair approximation would to say that something between 5 to 10% of contributors or managers should be seen. They're seen on average as key employees, and these are the ones that you want to retain. If they leave, the others would follow.
Yeah.
Or, that is even worse, they would not be delivering the same results they used to deliver.
The maximum impact of it.
Oh. What can you do? Well, a BI solution can, for example, gather information from LinkedIn profiles of the target company employees, and you can follow up on whether they have changed their experienced and skills section and what exactly was changed. And okay, we respect the GDPR legislation, or you can make it anonymous data, but you will still be able to see the percentages and what kind of skills were changed. You don't have to necessarily link these to a person. And what is more tricky, what is the percentage of the employees that have set their status to open to work? Well, guess what? Those ones are actually looking for another job. And if you are monitoring this aspect regularly and kind of launching some HR actions as like employees onboarding, rolling out, drafting and rolling out their further career development plan, and you see then the change that is being reflected or on LinkedIn, or you can have the questionnaires about different aspects of employing, like employees. You have those customers' happiness of customers' experience questionnaires. You can have the same ones with the employees. And yeah, you say you bought a company with 5,000 people. Yes. Would you be able to process it like manually? No,
Yeah.
of course you would. Yeah, you need the kind of system that would enable you to make a statistical analysis on that. And Excel is not going to be enough, I can assure you. What you have to also to acknowledge that from some positions, like you cannot have like two CFOs. Yeah, one of them should either leave, or if he is a key employee, he or
Change
she is
his role, maybe.
Yes, yes, and it's you're reaching both, I mean, two goals. The person is still meaningfully involved. It's kind of career development, because career shouldn't always be seen as like mere vertical progression to the top. Yeah, you can grow broad, you can gain broad expertise in more fields. And well, with the two employees, you also demonstrate, okay, to the others, you're sending a message like, look, we care about the social capital as a whole, and we try to retain the talent. And this is a tremendous thing, I can assure you.
Okay, thanks a lot. It's a great pleasure to have this kind of conversation, and I think we've passed through the whole M&A process. Um, give me just a second. I'll have a look if we have some questions from um, YouTube or from LinkedIn. Yeah, we have a question. Do you recommend any specific BI tool per each different vertical, specific for e-commerce project or for crypto wallets or kind of that? Some.
Well, I would start, okay, both e-commerce and especially the crypto, that is based on blockchain technology. They have the thing that they have in common is that the underlying data is already digitalized, and it's kind of organized in some way, because I mean, all is based on relational databases. Otherwise, your front end part of your solution would not just be performant enough. And a BI tool is a combination of the data warehouse layer, the ETL, and also the visualization tools. I would say pick the ones that start a tender, make the software experts come and offer their vision on how they would like to you to realize this project, because there is no absolute truth or absolute like opinion, advocate opinion. I'm gonna choose Power BI or Click
Or Tableau.
or Typo. No, whatever, wherever you have better skills or you see some really performance advantages, or the company that is rolling that you have partnered up with has already realized a similar project and that it has proven to be a success. So no, not to be, don't get led simply by a name of BI tool.
Okay, thank you. Hope this is a good answer for the question. So one more we have. What do you think? Which one is better? If both companies had BI before the M&A, or if they didn't have it at all? Nice question.
I have not yet encountered a single case in my practice when both companies were having BI systems that were comparable to each other. In most of the cases, either none of them is a full scope BI solution, or we have a company that acquires another and that company, the big company has already BI solution, whilst the small one doesn't yet have. And well, which is better? I would say the ideal scenario for me would be if both companies, of course, had a BI solution, and that's only in terms of the rollout of consolidated solution.
Time of integration we
Yes,
decrease.
the time of integration, the budget would get reduced. Everyone would get happy. Everyone would get to the access of the
It
whole
would-
data's company. You just have to remap to add some magic under the bonnet to to streamline your master data, etc.
Mhm.
But then a potential miss would be like you just you just followed the practices that used to be there before, and probably like if you really believe in realizing the synergies, this is a good moment not say to start from scratch,
Mhm.
but to rethink. And actually the way you have the horizon you should be looking at is like, okay, where I want my company to be in 3 to 5 years, and what kind of BI solution would be performant and scalable enough to be able to support my business over 5 years. So there is no single truth. You should be looking at every single case. In other words, yes.
Okay, thank you. So one more. At which stage of M&A deal, in your opinion, are there more possibilities for BI tools to bring value for the stakeholders when the potential benefits of their usage are the biggest?
Uh-huh. Um,
I like the question.
well, the way it works, in my opinion, Alex,
Mhm.
is that you are changing from uh, not not getting deceived and then frustrated because you you bought something that was not worth buying, or you paid way too much, or you have not identified some compliance issues uh, at the pre-deal and due diligence.
Mhm.
Even at this stage, you can empower and roll out the BI solution. At the deal stage, at and at the start of post acquisition, yes, you already start thinking about, well, how I will be able, what I have to do to be able to demonstrate that yes, I'm realizing the synergies that the big bosses or the experts from whatever company was supporting the deal have calculated. And then the real life, yes, the post acquisition, uh, in my opinion, the potential benefits
Mhm.
are for the post acquisition stage, because you have you can gain from from making people from two companies talk to each other and to exchange their ideas. And probably when you have like a integration budget, you will be able, by miraculous way, by like encouraging people to speak up, to reach better results in terms of synergies, because otherwise they wouldn't dare to voice them, because there was no enough budget in a standalone company to realize a kind of the implementation of some digitalization part or analysis part with the usage of BI. But first of all, yeah, now there is a budget, and second of all, a BI solution doesn't have to cost you more. On
Mhm.
the contrary, I often see, like, remember the Pareto principle,
Mhm.
80/20.
20. Uh-huh.
Yeah, I mean, it's incredible. Like, people are saying, you're gonna need how many months? Yeah, how many weeks would I need to demonstrate that you can benefit from the results, from the insights created by BI solution, like 2 3 weeks already. And so the move is from risk avoidance to getting your hypothesis supported by the data
Mhm.
to reaching gains and benefits.
Okay, thank you. And we have the last question and a couple of minutes left. Who should be, according to your project champion of BI tool engagement in the implementation of BI technology in M&A deals? Would it be CEO or CIO or CFO? How do you think?
I have seen quite a few times people having completely wrong perception about the CIOs and the IT guys in general. It's like, don't touch, that is working.
Mhm.
That works. Don't touch it, right? It's already working. And I see it in the practice, it is true. It's not about a CIO not showing up enough, not having enough guts, and not showing enough initiative to contribute to the BI technology implementation. Or it's just it, specifically in M&A deals, IT guys, IT CIO is only asked for like to provide an opinion on whether the digital, what the digital maturity stage is of the target company, and would the network system need an upgrade soon, something like that. Very banal things.
Mhm.
And this is, I mean, who are to blame? Two other guys, or just the practice that is not yet been adopted by everyone? Actually, they should be acting as a council. Yes, of course, the person that is launching the initiative is often okay, either the shareholders or the CEO.
Mhm.
But then all the maths, all the substantiation is being done by CFO in cooperation with boys and girls from consulting companies, from whoever. And when yes, then there is also a big need in the CIO actually to understand what kind of IT backbone upgrade the new structure gonna need, and when, and what's gonna be the budget, and how soon. Yes, and how, and what exactly would be the result of implementing a BI technology if we were not only replicating the solution that the acquires company had.
Had before.
So it's a question about, it sounds probably banal, but about out of the box thinking. But look, M&A deal is a big change, is a big bomb moment, and probably it's the right moment to fully engage your people in voicing up the new ideas, in coming up with the initiatives. Okay, you have to streamline them with a general strategy of development. You have to make sure that the projects they are launching are profitable, that you have enough budget, or you just select the projects that are coming out as the best from the project comparison study. But again, for the BI solution, it doesn't have to cost you a lot of money.
Okay. Thanks a lot, Maxim. It was a very interesting conversation. And I also thank everyone who connected with us on LinkedIn and YouTube. See you next time, Maxim, and see you next time also. Thank you. Bye.
Thank you. Bye-bye.